Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing pretty good. How about yourself?
Good, thank you. Today, we're in December of 2018. We're going to talk about volatility a little bit, and we're going to talk about mistakes that people make with their retirement planning and investments. And we'll talk about ways that you can try to avoid some of these mistakes. But these are things that we've been seeing here most recently in the office and or talking to investors out there. The first one we're going to talk about is trading your portfolio based on what the media says. Okay, I have to be careful here because I'm on radio right now, a form of media. But if I've heard it once, I've heard it 100 times. People will come in the office and we'll talk to them and they'll say, well, I heard on CNBC or I heard on Fox or I heard whatever it is. I heard this place that you should sell because interest rates are affecting the market and we need to get out, or the yield curve is starting to flatten, or tariffs or trade, or you hear pros and cons all the time, black and white, left and right. Understand the media is there to sell time. It's to sell sponsorship. Okay, so when people start talking about the market or a particular investment, for every person that says you need to sell, you're going to find another one that says you need to buy. For everybody that says it's a bull market, you're going to have somebody that says it's a bear market. For everybody that says you should be in gold and silver, you're going to have somebody else that says you shouldn't be in gold and silver. These are all of the things that really get people confused, but it's an attempt to sell time and so on. You really need to get through that. You need to do a little research. Don't go out there with the idea that, hey, I have a financial advisor, they'll do everything. The bottom line is, and Tyler and I tell this to people all the time, it's your money. You should really know the fundamentals of investing. It's your money. Would you feel comfortable putting 100% of the onus on a financial advisor to go in and manage your account with absolutely zero input from you? I wouldn't feel good about that, not only as an investment advisor, but also as an investor. So really make sure that when you're hearing things about the media, you dig deeper into it. And we're going to talk about some of the basics on how you can dig deeper into it. But Tyler, what else when we're talking about the media?
Yeah, Dean, so obviously this one is a really big one in today's day and age. You hear about different media outlets all the time. We're in such a media-driven world that we live in right now that they can affect many things, that the media can affect many things, including investing. And one of the main things that it does, if you listen to the media and start to trade your portfolio based on what they say, it can lead to emotional decisions with your portfolio rather than rational ones. And when it comes to investing, you always want to make rational decisions as opposed to knee-jerk emotional decisions based on the media. And the other thing that the media can do is they can use scare tactics. Each side has their own agenda, so you want to make sure that you're doing research on your own, getting unbiased information. And again, when it comes to what the media says and how it can be so emotionally driven, what you can do to try and combat that is, number one, as you said, Dean, do research on your own. Go to different unbiased sources and try and get that information, look it up online, read books, different things like that. And once you do the research on your own, then you can kind of dig deeper and try and get information that's unbiased, that doesn't have a right wing or a left wing side to it, just unbiased facts. And then from there, when it comes to investing, turn off the media outlets and simply stick to your long-term financial plan, because that's what the main thing comes down to. Instead of trading your portfolio and making decisions based on media and emotion, you want to always stick to your long-term financial plan, because over time, that's what's going to keep you grounded. That's what's going to keep you heading in the right direction, as opposed to making these short-term decisions whenever you flip on the TV or turn it off.
Okay. So when it comes to the media, again, just make sure, there's some really good sources out there. Try to get through the clutter. I had one client say they need a filter. Is there a filter out there that I can use to get through some of the clutter? Try to go to some of the unbiased areas to do some research. Morningstar tends to be a good one that doesn't bring a lot of political play into it, which is good. Also, they don't get into a lot of narratives that just sell a story. The other thing you should really do too is many times you'll find an article out there where somebody is saying, here's what you should sell or buy or get out of, and the market's going to go down or it's going to go up. I challenge you to take that author or that journalist and Google their history and find out, are they an expert? Are they an investment advisor? Are they a hedge fund manager? Do they have anything to do with the economy? Are they an economist? What are they? Many times you're going to find out they're a good writer, okay? And they just happen to be in the financial industry, and that's why they're writing about this. So read through some of these things a little bit. Do your research. Don't necessarily believe everything you hear. Okay, another mistake we see is not sticking with a plan. And what we mean by this is anybody that wants to come into our office and get a complimentary financial plan, we're more than happy to take them through it. We will take you through creating a financial plan. It's going to stage out your withdrawals. It's going to look at Social Security. It's going to look at what happens when Medicare Part B comes out of your Social Security, your conversion from paying health insurance premiums to Medicare, your withdrawals. Should you be withdrawing from non-qualified accounts or from IRAs or from Roth IRAs or cash? We stage that out. We look at tax implications, all of these things that go into a financial plan. You'll put together an absolutely wonderful plan for somebody. They feel really good about it. They have their budget included in the plan, and then you'll meet with them 6 months later and find out that they did absolutely nothing with that plan. A plan is nothing more than a piece of paper with numbers and words on it if you don't implement it. If you implement that plan, it is going to help you navigate some of these pitfalls in retirement for 10 years, 15, 20, 30 years. So if you have a retirement plan that's put together, it's designated to writing, a lot of thought was put into it, chances are you're going to be significantly better off if you stick to that plan than if you go off and do your own thing. Tyler, anything else about not sticking with a plan?
Good points there, Dean. When it comes to not sticking with a plan, oftentimes we find that so many people, and this holds true more so for younger people that I see, and rightfully so, but so many people, they try and plan for retirement without an actual financial plan, and it's simply not going to work. When it comes to your retirement and planning for retirement, that's something that you can't necessarily just wing it. You have to have certain numbers and a game plan behind it. And if you don't have that plan, then how will you know how much to invest in your 401k? How will you know what your budget should be? So again, this is all something that should be done ahead of time, and you don't want to start retirement planning as you're heading into retirement. This should be done well ahead of that, so you know, okay, when do I want to retire? When is the date that I'm going to retire? What's my Social Security benefit going to be? How much do I need to put away now to hit a certain number in retirement funds that can last me throughout my retirement? So all this goes into it, and you want to first off get a financial plan. As you said, Dean, it comes to creating it, but then once you create it, you have to stick to it. You have to go out there and execute the game plan, and over time, that's how you're going to be successful, and that's how you're going to stick with it, is execute and actually do it. The other thing that I wanted to point out is that oftentimes financial plans, they can also uncover different investment and retirement planning mistakes that many clients actually aren't even aware of. And what I mean by that is they might have a financial plan that shows their retirement funds growing by 7, 8, 9, sometimes even 10%. However, they're allocated to 80% bonds, which are more conservative, and they're simply not going to average that, 7, 8, 9%. So that's the other thing too. You want to make sure that, okay, if you have a financial plan put in place, then your investments and your budgeting and what you're allocating or contributing to your 401k match the financial plan. So once a plan is in place, you have to always go through and tweak your investments, your 401k contributions, your budget to make sure that you're actually executing it and you're sticking with it. And the opposite also holds true as well, where if you have a financial plan and you're estimating that your retirement funds grow by 5% per year, you probably want a moderately conservative to a moderate portfolio to reflect that. And if you have everything all in the stock market, then you're going to be surprised if we have a big downturn in the market and you're down 15% when you only expected to be down 5 to 10%. So again, you want to be sure to stick with a financial plan. But the other thing that financial plans do, like I said, is they uncover different investment mistakes that you want to get taken care of as well as you head into retirement.
Okay. Another one we see is one of the mistakes that people will make is they just don't understand the terminology or don't want to understand the terminology. And what I mean by that is it's very important to go and understand the basics. Again, if you are entrusting your financial advisor to make all 100% of the decisions, I say get involved. You should really be involved. Why? What did I say earlier? And that is, it's your money. Don't forget that. But understand some of the basic terminology. You can go to someplace like Investopedia to get the basic terminology. I'm not saying you should go there to get investment advice. You should go there to understand basic terminology. And for instance, here's where terminology and a little research would really help. I talked to an investor a while back who said that they just bought a significant portion of GE stock. And I'm not recommending this. I'm using this as an example. And I asked, well, for what reason? What is the reason that you chose GE? And their response is, it's low. That's not a good reason to buy stock. There are stock out there that's significantly lower than GE if you just want to go buy stocks that are at a low. And don't forget, many times stocks are at a low for a reason. Okay, so what you need to do is know some of the basics about picking stocks and investments. Find out what PE means, okay? Very, very important so you can tell the difference really from a growth stock or a value stock. It's important to know. With growth stock, remember, most of their profit they're going to make, they're going to dump right back into the company to grow it, continue to grow it, so therefore the stock value should go up over time. If you're looking at a value stock or a dividend producing stock or preferred, what happens there is many times that company is a very mature company. So what they do is instead of organic growth that they're looking at in their company, they instead look at giving some of those profits out to the shareholders in the form of dividends. However, some of the value stock pays nice dividends, but you might not see significant growth in their value. So understand the basics so you know how to read your portfolio and the trends that they're taking you, whether they're up, down, or static. Another thing is correlation. Understand what correlation is. And I explain that to people that come in with mutual fund heavy portfolios. Somebody will come in with a $50,000 portfolio and hold 10 or 15 mutual funds thinking that more is better. Not necessarily. Correlation is really the overlap of underlying investments in that mutual fund or exchange traded fund. Know what correlation is. Understand where to look at it. You can go to Yahoo Finance, Morningstar, MarketWatch, and find out what makes up a mutual fund or an exchange traded fund. And many times you'll find the same company represented in the top 10 holdings in many, many, many mutual funds. So understand correlation. More isn't always better. Sometimes having too many mutual funds or exchange traded funds in a portfolio actually waters down the portfolio because you have so much overlap, which is correlation. Look at returns versus trailing returns. Understand how to determine the difference between returns and trailing returns. Understand the terminology. Standard deviation. For those people out there who really want to get market gains but are not willing to take some of the market losses, understand what standard deviation is. It's a term that talks about the risk that's held in the portfolio or the stocks. Tyler, what else when we're talking about terminology?
Yeah, so one thing that I noticed right away is those clients who take the initiative to just simply understand some of the investment terminology, they're the ones that feel most comfortable when it comes to any type of market downturn, and they understand things better and it makes them feel more comfortable. So just by going out and doing that and understanding the investment terminology can make you feel more comfortable as an advisor. You're able to stomach a lot of the market volatility more so, and that's simply what I find by a lot of our clients that do take the time to do that. But again, like you said, Dean, the website that we really like is Investopedia, where it explains different investment terms and concepts really well. So if you can go just understand a lot of the basic terminology, that's going to help you become a better investor and know what's going on with your portfolio. A couple other terms, basic terms and concepts such as expense ratio is another big one, where that 99% of Americans who have a 401k offered through work are invested in mutual funds. And those mutual funds have what's called an expense ratio. The expense ratio is simply the internal fees that you're paying. So whenever you're investing, you should know what the fees are that you're paying. And the number one term for that is your expense ratio. So you could go in, you get your 401k statement, you see all those ticker symbols. You could simply Google those, just type those in online, and it should pop up right there. It shows a little thing called expense ratio, and that's the internal fee that you're paying. You're paying professional managers to manage your mutual fund. So again, that's the fee that you're paying. Another basic term would be asset allocation, and that determines the ratio of stocks to bonds that you have in your portfolio, which will determine, if you're more so conservative, moderate, or aggressive. It's how you structure your portfolio in terms of the risk and reward that you can take. So again, just a few basic terms there, but understand the terminology. That's a big mistake that we see people where, they just don't care to, or some might be too lazy to. But if you can go through and understand some of the terminology, it's going to help you become a better investor, and it's going to make you more comfortable through different times of market volatility, which is what we're seeing right now.
Okay, before we go on to the next mistake that we're going to talk about in retirement or in investment planning, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back, and we're talking about the next mistake we tend to see people make with their investments, their portfolios, or the retirement planning is you will have the misperception that you are going to get stock market returns in your portfolio. Understand, when the stock market goes up 10% and you expect your portfolio to go up 10% or greater, a couple things are happening. First of all, if you're expecting to get returns that the Dow is getting you, you need to be holding those investments that are in the Dow, those 30 companies in the same proportion that the Dow is set up. Most portfolios don't have a 100% stock selection. They hold bonds and they hold some cash. Well, bonds are not going to give you the returns that stocks will, and cash will not give you those returns either. Cash is being held for safety reasons and to be able to buy investments at a low should the market go down. So understand, if the market is up 10 or 15% and your portfolio is not, it's either a balanced portfolio or maybe it's just not within the risk that you're willing to take. Also remember too, if you're wanting to get returns that the market is giving, you better be prepared to take the losses that the market is giving. Because again, if you want stock market returns, even with what the market's doing, you have to be willing to take those losses too. Because very seldom are you going to be able to manipulate and move out of a particular sector or market to avoid all of the downturns that could happen. So understand that. Some people feel comfortable with index funds. They follow a market, okay? But again, you have to understand that it's very hard not to take the significant losses that the market may have too, to go along with the gains. And when the market is good, it's funny how investors will change their risk tolerance to a more aggressive nature. And when the market is bad, they want to go down to a relatively conservative nature. Okay, one flaw with that. First of all, if you're wanting to take high risk to get those returns, but when the market goes down and you take your risk analysis and go very conservative, your recovery time is going to be significantly longer. So many times, unfortunately, the stocks and the investments that brought you into that hole are probably best served to take you back out of that hole to a certain degree too. So Ty, what else are we talking about here when it comes to the mistakes of people wanting to get returns of the market?
Yeah, Dean. So first off, everyone wants to get all the market gain and then some, but they don't want to take any of the market losses. And if there's a certain investment out there that can do that, I want to know about it. But oftentimes we find that, especially in 2017, this was a very common one where you want to try and get all the upside, But in addition to that, you're also going to take the downside if you're fully allocated to the market. So, they'll ask and they'll wonder why they're not getting the full market gain. However, you have to take a look at your portfolio, because if the market's up like it was in 2017, if it was up over 22% and you got maybe 12, 13, 14%, you were most likely in a moderate portfolio, which meant that you also had some different bond funds in there as well, which didn't give the full market gain, but they're more conservative. They can help protect against big market losses. So if you didn't get the full market gain and you were expecting it, it's probably because you didn't have a full aggressive portfolio that's fully allocated to the market. And as you said, Dean, you can, if you want to get the full market gain, then you can be in an index fund, is what it's called, that it gets a full market gain. However, what many people don't realize is that you also get the full market loss as well. So if the market's up 10% in any given year, you'll be up 10% or right around there. If the market is down 10%, you'll also be down 10% too. So keep in mind, if you're in a pure index fund, you will get pretty much the full gain of the market. However, you're also going to take the full losses as well. So you need to be, ultimately what this comes down to is you need to be allocated to a portfolio that you feel comfortable with when it comes to potential risk versus potential return. And what I mean by that is, instead of being in a full-on index fund where you get all the market gain but you also take all the market losses, maybe you're better off stomaching a moderate to moderately aggressive portfolio where you might try and get 80% of the upside and only take 60% of the downside. Meaning if the market is up 10%, you might be okay with getting 8%. And on the flip side, if the market's down 10%, you might feel comfortable being down only 6%. So that might come with a moderate portfolio. So again, you want to be allocated to a portfolio that you're going to feel comfortable with, and that comes with evaluating your potential risk versus your potential return that you're willing to take.
Okay, another one we're going to talk about is, and this is a big one, understanding that conservative does not necessarily mean safe. And I'm going to say that again because we hear this a lot. A conservative portfolio doesn't mean it's necessarily a safe portfolio. Now, many times conservative portfolios are safer, but it does not have to follow that trend. And part of the reason is conservative portfolios are usually very heavy with bond positions. And if you've been watching the market, bonds are not really performing all that well. Okay, as a matter of fact, they are going in the same direction stocks have gone when stocks have gone down. Unfortunately, the bond positions haven't gone up substantially when stocks have gone up. So in the past, bonds had an inverse relationship with stocks. Typically, when stocks went up, bonds didn't do all that well. Typically, when stocks went down, bonds went up. Again, we're not seeing that. We're seeing bonds are really stressed right now. So if somebody has a very conservative portfolio, it doesn't necessarily mean it's safe. There is significant risk in bond positions. Right now, the global bonds are not a place I would really want to be, and long-term bonds are carrying significant risk at this point. So understand, when somebody says that their portfolio is conservative or they're a conservative investor, doesn't mean that their portfolio is necessarily a safe investment. Safe to us is a cash position, okay, or a guaranteed investment. So understand that conservative isn't always considered safe from a standpoint of not being able to lose, part of the value.
Yeah, Dean, and this is a big one, especially as of late with the recent market volatility that we've been seeing. But yeah, I've heard this a number of times over the last couple of weeks, where people might say that they have a conservative portfolio and they think their portfolio won't lose any money because it's conservative. Well, keep in mind, anytime you have money in the market, whether it's stocks or bonds, you can lose money in there. And as you said, Dean, the only safe investment would be cash and different types of fixed annuities and CDs and things like that. But just again, keep in mind that just because you have a conservative portfolio doesn't mean you can't lose money. Now, if you have a conservative portfolio, I'd be willing to bet that you won't lose as much money as someone who has a moderate or aggressive portfolio if we have a market downturn. But you're probably not going to get the gain that they do either if we have a market like 2017. So just one thing to keep in mind, if you have a conservative portfolio, that doesn't necessarily mean safe. You can still lose money. So therefore, you want to make sure that it is risk managed and the investments within your conservative portfolio are allocated based on the market, and they're always, risk managed based on what's going on.
Okay. Another one here, getting away from investment side a little bit more on the retirement planning. One of the mistakes we hear quite often are those people who believe that if their spouse passes away in retirement, they get both Social Security benefits, their own and that of their spouses. And again, we're hearing more and more people bring that to our attention, that they believe that. One thing they should really do is talk to an advisor who specializes in retirement income planning. We do, as the name of our company, Secure Retirement Solutions. Retirement is the main part of our business with the investments. So talk to somebody who can look at and explain to you how Social Security works. The other thing, too, is the Social Security Administration website, ssa.gov, has got a great bunch of resources there. Go there and take a look and see what you can find. It's going to answer a lot of your questions. Tyler, how does it work here when we talk about if a spouse should pass away?
Yeah, Dean, this is a common misconception that I've gotten asked a lot about recently. And what happens is many people think that if you're married and your spouse passes away, you continue to receive their Social Security benefit. However, that's simply not how it works, because when a spouse passes away, then the surviving spouse only gets the larger of the two benefits and the smaller one goes away. So for example, if you have a husband and wife, and let's just say the husband's Social Security benefit is $1,800 and the wife's is $1,500, if the husband were to pass away, then the wife would continue to get the $1,800 benefit. She would step up to his, and then hers would go away. And then if the wife had passed away before the husband, he would continue to keep his $1,800 benefit, and her lower one would go away. So that's the other thing. You do want to plan for a loss of income in the form of Social Security when you lose a spouse, because you will only be getting one of the two benefits. You get the bigger one, whether that's yours or your spouse's, and then the smaller one would go away. So that's just the last one there that I wanted to talk about when it comes to Social Security, a misconception that we've heard a lot lately. But again, when it comes to a spouse passing away, you receive the larger of the two, the smaller one is gone.
Okay. A couple things. We talked about a lot of things today. If any of these things pique your interest, you want to find out more, please give us a buzz. We're located in Green Bay, 3040 Allied Street. You can call our office at 920-347-9888. Tyler and I would be happy to meet with you, explain some of these things, or to put together a complimentary financial plan or give you a second opinion on your current investments. So just give us a buzz. Folks, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.